original thesis is that they were going to come in around 7 to 10%. Now, because what we think is going to happen is right now the the Fed is proposing this 9% increase. But remember, this is the re-proposal. The banks have to go back through the comment period again. And so it's feasible that the Fed could come down even more than that. Because ultimately what the Fed is trying to do here, they're walking a really tight rope. And I'm saying the Fed, but it's also the FDIC and the OCC, is they have to finalize a rule that the banks can essentially say, okay, we will live with this and we won't sue you on it. Because if there's a lawsuit, there's a chance that this rule never goes forward. Because if you go into the Fifth Circuit, the Supreme Court, they've been very skeptical of these types of regulations in the past. So the Fed, I think, is trying to come out and say, okay, look, we were wrong with 19%. Let's go to 9%. We will opt out of those banks that are below 250 billion. Those small regional banks between 100 and 250 are now out of this rule. And let's try and come up with a rule where you don't sue us ultimately in the end, because that's something that eventually could stave off the Basel III Endgame, even if Kamala Harris wins the presidency.
I mean, this has taken so long, Nathan. I don't put the blame on you. I know you're just analyzing this stuff for us. Is there a sense that Congress, it's like, there's no problem here. What are you regulating at this point?
Well, that's a good point.
Well, look, I mean, this is actually a fairly short timeline for a rule. I mean, I've got rules going back to 2011. They're still out there, and they haven't been finalized yet. So, I mean, going from a proposal in 2023 to now, this is pretty much on par with the normal rulemaking process. But we have a couple of catalysts that will make it really important. First is the election. If President Trump wins, we think this rule is essentially indefinitely delayed. The head of the OCC would flip, and the head of the FDIC would likely flip, and therefore we would think, nah, we're good, we're out. Now, the other thing to keep in mind is like this court argument, because we're going to have a 60-day comment period that will probably be released. Bloomberg News is reporting it could come in as soon as September 19th. Comments would then be due in November, potentially even extended into December. But then we think that the Fed will go back and probably have to spend another 6 to 9 months analyzing this to make sure that they don't get sued. And the reason why this is important is because the original implementation date for this was July of 2026. And that's most likely going to get pushed off. And as a result, we've seen in the United Kingdom, for example, they pushed off their capital requirements associated with the Basel IV, which is essentially the Basel III Endgame, as a result, because they aren't sure the Americans are even going to move forward with this.
Right, because in theory, then that would leave European banks at quite a disadvantage, no?
Yeah, absolutely. I mean, there's one thing that we've heard in terms of bank lobbying for the last 15 years of my career is that everybody just wants a level playing field. Now, that could be in the same ballpark. It's not going to have to be like for like on the exact numbers. But if you see the Americans pull back from the Basel III Endgame, I would have to imagine that the European banks that are adhering to Basel IV would at least be whispering into their regulatory leadership saying, look, if the Americans pull back, we should do the same here. And so I think it's just one of those things where every agency, every jurisdiction doesn't want to be the first one to go. But because the end game is the last remaining piece of the Basel III Accords, this is very important for the Americans to get right or to pull back because, I think global capital just across the globe is going to be very much impacted as a result of what happens here in the States.